All right, we're going to move to Brett's segment. He is doing Perimeter, a company with AI at the end of its name. I do know that. It's a TSX venture listed company. Its symbol is pink, I believe. And we're going to see if this company deserves your further look in your portfolio. I think I've got an opinion on it, but I'm going to let Brett take that.
Yeah, so like Ryan said, the name of the company is Perimeter Medical Imaging AI. So that AI right now, I think, could give a red flag to people because some companies are just sticking it in their name or in their name somewhere, or artificial intelligence in some form just to get that stock market boost, since it's been in every single conference call, or what seems every single conference call for the last year and a half. So does the company have really any substance? So Perimeter Medical Imaging, AI symbol PINK or PINK on the TSX Venture, is a medical technology company focusing on cancer imaging tools. The company's current product stack includes Perimeter S-Series Optical Coherence Tomography or OCT, Tissue Mobilizer, and Atlas Image Library. It has an AI software in development as well as its B-Series OCT, which is currently in clinical development awaiting enrollment of potential users. The technology's goal is to better allow surgeons to achieve clean or negative margins on surgical cuts to remove cancer, which effectively means the cancer has been fully removed. The OCTs allow for real-time monitoring at 10 times the resolution of an X-ray, and the AI integration in the future would hopefully be used to identify cancer cells. Effectively, the goal of the company's products is just to have better cancer removal in layman's terms. Looking at the company's share performance has not been great. However, the stock is currently trading at 47 cents a share, or 30.6 million market cap, down 74% over the past year. So let's dive into why has the company's stock fallen so much. The company has really no significant revenue, only 98,000 in the last quarter, and it's been around that 100,000 mark for a while now. And as the company is actively marketing, developing products, it does have significant expenses as well. Sales and marketing of 1.3 million, R&D of 1.4 million, and general and admin of 1.9 million. Normally, the company does have some offsetting FX gains of 900,000 and 1.6 million in net finance income. FX gains is out of control of the company and aren't inherently recurring. Last times they do actually revert with the nature of FX. As well, finance income isn't primarily due to net interest income like you do with many companies like this, which they do have a cash balance sheet. However, it is due to 1.5 million in warranty liability reevaluation. Warrant revaluation resulting in a gain. Effectively, the share prices drop, so warrants aren't in the money or likely as to be in the money. Substantially lowers the likelihood that they'll have to actually issue shares, resulting in a gain on their income statement, but it's really just accounting, and it's not a real money gain, and it's actually to do with their share price dropping, so it's not even a great thing to see at that. The resulting of all of this is a net loss of 2.1 million for the quarter. Switching to the balance sheet, like I said, the company has cash of 10.6 million. However, as we can see, the cash balance has just consistently dropped over time. You can see that big jump up at Q1 2022, and that's due to them doing a private placement, raising 48.7 million at the start of 2022. And since most medical device companies or development companies, they've burnt through cash over time. You can see that relatively consistent burn quarter over quarter, as they don't actually bring really any cash in, only out. And we can look at the cash flow statement to really drive that point home. We can see the company had a cash deficit before working capital changes of 4 million, and after working capital changes for operating cash flow, which includes receiving grant money of 855,000, there was still a deficit of 3.6 million. So the company is really burning through cash, and that's not an abnormal quarter for them. That's a normal quarter in that range. So the likelihood is they're going to need to raise cash likely within the next year, given they have 10.6 million. You can roughly annualize 3 to 4 quarters, depending on if they cut back or any additional grant, which they are expecting a bit more grant money to come in. They expect another 2.4 million in grants to come in over time, and they have about 1.5 million of receivable on the balance sheet, but they're likely to get that 2.4 million, which isn't directly on the balance sheet at this time. But even then, you're looking probably close to 4 quarters or so cash runway at this time. So looking at the company's long-term plan, Perimeter is looking to use that S series OCT, which is their current one that is actually getting delivered in some capacity, as initial seed for adoption, and then leverage that network of people who are already using it with their B series and then that AI imaging technology. And then that's where they actually plan to get some sort of return. So the company is spending significant money on marketing, but they won't likely get that money anytime soon, as they need to wait for that B series launch. The company is looking at completing enrollment for the B series and Image Assist AI to be completed in Q4 2024. So that's looking at effectively 3 quarters from this point, which means at that point they would effectively burn through all their cash at this rate before they're even done the initial clinical testing, because that's only enrollment, of course. So likely they're going to need to raise additional capital just to develop the product to market, which as an investor, when you're looking at these sorts of companies, how long do they have until they need to raise additional capital? And for Perimeter, it looks up to be about a year, unless something drastic changes in the company, which can sometimes happen with companies in this space. Concluding, the company, like many medical development companies, is on a cash burn driven timeline and has significant getting to market risk. First, the product needs to be viable, which at least it does seem to be in this case. There is some viability, but then it needs to be adopted, which is why you're seeing that high marketing and sales expense compared to their current cash, or especially compared to revenue at this time. And then it needs to be scaled enough to be profitable or cash flow positive on the initial cash burn timeline, and that doesn't seem to be happening on their current trajectory. If the company does beat the odds and does make it to market in a profitable manner, I would take another look. But for now, I would just pass, given the significant risk of getting the product to market, and given that they only have really a year left in cash at this time.
Yeah, that's a good summary. They may be doing some good work in their field, for sure. But we look at companies from a profitability basis. It just isn't there. It doesn't meet our criteria. We'll monitor the business, but it cannot be a buy in our research right now because there's no cash flow there and really nominal, sorry, revenues.
Yeah, and I'll really drive the point home is, remember, you're investing in the equity of a company, not just the product. So
Yeah.
even if the product does good 5 or 10 years from now, if it's groundbreaking, if you get diluted 10 or 100 times, which does happen in these companies, they'll dilute, roll back, dilute, roll back. And that's why you'll see sometimes some obscure and strange price charts.
Mhm.
But if that happens, your shares, even if you invested $1,000 and it becomes world breaking, it helps really treat cancer, and obviously that's a great thing. But as far as your investment goes, is you likely didn't make any money if you invest in these companies and they dilute 10 times,
Yeah.
100 times before it really does anything.
Yeah,
Yeah,
exactly. Like,
and there are other options. Like we're looking at biotech, pharmaceutical type company. There's a one we bought in the fall, and we're looking at one right now. But you can buy them with net cash positions, growth, business, and like under 8-10 times earnings. And if you want to own and have exposure to that segment, there are far better companies that trade at low valuations that can be bought today. And we would look at those businesses versus one that's really in the initial stages that you're taking a massive bet on right now.
mhm, exactly.